Hi, good morning, and welcome to Capital Grounds Podcast. I'm your co-host, Nick Miller. I've got my other co-host here, Joe Fisher. Morning, Joe.
Hey, good morning, Nick.
We're with SITG Capital. We are a multifamily real estate investment firm based out of Texas. We've got properties in Houston, Austin, Dallas, San Antonio. We're currently in the process of growing quickly. Got a lot of great opportunities out there. But this morning, we're bringing you Capital Grounds. We're bringing you a little
hmm
bit of coffee. That's the grounds part. That's what I enjoy. We're talking about real estate. That's the capital part of it. And digging into some what I think are interesting topics
hmm
and just having a good spitball about it. But Joe, how are you this morning?
Hey, I'm good, Nick. We've cooled down here in North Texas and well throughout Texas, really. So, it's definitely fall, and we're feeling good and moving forward. And yeah, we had a busy week last week, so we had a lot going on last week, and so we feel good about where we're at right now this time of year. How about yourself?
Yeah. So for our viewers, listeners, I was in Dallas all last week. Well, Dallas and Philadelphia. We had a lot going on. Um,
And Austin,
and
we
and Austin. Yeah,
getting all over the
yeah,
place. Yeah.
all over the place. Yeah, but it was a great time. It was a great time. We met with a lot of clients,
hmm
looked at some new properties. We broke ground on a new
We
project in
did.
Dallas. That was
Yeah, in
exciting.
fact, I'm sitting here in my office and I'm seeing them work on it. I can see the progress kind of as we speak here. So it's pretty exciting to see that happen.
That's awesome. That's awesome. I've got to say, I'm always amazed at how quickly, uh, those guys get to work and really change the landscape. I mean, I think last Wednesday it was
Yeah.
just like a concrete slab, it was just
Yep.
concrete everywhere. And by Friday, uh, everything was cleaned up, like all the junk that was on there was gone, and a
hmm
lot of it was dug up. And yeah, I was just amazed at how quickly progress was being created there. So yeah, it was awesome. It was awesome.
Yeah. Yeah.
But
It's great to see. And yeah, like Nick mentioned, we've got more coming, and so we've been working hard on that. Nick had two conferences last week. I had one, so just a busy week, but in a very good way for us, and that's what we like. We like to stay busy on this stuff because we do enjoy it. So we want to be in it day in and day out.
we do. Joe and I have been friends outside of work for a
Mhm.
long time, and man, I gotta say, it's great to be able to hang out with your buddies and and chit chat about work and not be burdened by it. It's stuff that we
Yeah,
enjoy, stuff that we
absolutely.
love. So it's good. It's good. But
It
Joe,
is.
what are you drinking this morning?
Well, I've got my old staple, Cafe Bustillo. Just still
Mm.
enjoying that, and it hits a little better when it's a little cool outside, and you can see I'm wearing the sweater this morning because I'm a pretty cheap individual, and I don't really turn on the heat unless I really need to, or turn on the AC unless I really need to. So that's just how I've always been. But it feels good to me right now. I think we're about 60 degrees, so it's pretty nice actually. But I know, Nick, when you were down here, we went to, I've talked about it a couple times, Full City Rooster, coffee roaster, coffee shop here in the neighborhood that we are currently have three projects in that we're developing. And so we got something interesting. And Nick, I think you might have it there with you. Um,
Topo Chico
Love to
cold
hear about it.
brew.
Yeah,
Yeah, so Joe's mentioned it quite a few times
I have.
when we were out there. This was on my to-do list. So we
Mhm.
went and got some, and what I understand, the roaster there at Full City Rooster,
Michael is
um,
his name. Yeah,
Michael. Okay, yeah, right,
yeah.
Michael. So Michael, cracks open a bottle of Topo Chico and
hmm
drains a portion of the mineral, the carbonated mineral water in here, and then adds his own house cold brew to it, and then not rebottles it, but puts a new cap on
Yeah,
it,
seals it back up. Yeah,
seals it back up. Yeah,
yeah.
yeah. So this made it all the way home. I got to tell you, so while I was in Dallas last week, it was raining a lot, a lot. In fact, we had to
Yeah.
drive back from Austin Thursday morning in really, really heavy rains, really dangerous heavy rains.
Hmm.
But when I got my suitcase, when the suitcase came out of the baggage check, it took me about 10 minutes to recognize it because it was much, much darker than what I expected. And when I finally saw it on the rack, I pulled it off
Uh-huh.
and it was soaked. The whole thing was soaked.
Oh, yeah.
And I just knew that my bottle of Topo Chico inside had exploded, but it didn't. Thankfully, it was just rain. And
Oh, wow.
yeah, I've got to tell you, I really like it's a new experience. It's a new
Hmm.
experience, and it's neat because the carbonation isn't it's not overwhelming like it is if you're drinking a
Sure.
Coke or a soda,
Hmm.
it's almost like effervescence. It's very light, it gives nice tongue flavor, and the cold brew itself is really smooth and tasty. So anyway, Topo
Agreed.
Chico cold brew, check it out. Full City Rooster in Dallas, downtown Dallas in the Cedars area.
Hmm. Yep.
Yeah,
Yeah.
it's good
Yeah. No, I'm
stuff.
with you. I'm with you on the flavor, Nick. I think it's fantastic. That's one I can just drink. I usually like to put something in my coffee, whether it's oat milk or, I like lattes, things like that. You can make fun of me if you want, if you're a real coffee drinker, but that's one of those that I can drink without anything in it because it has some good flavors to it. And like Nick
Mm.
mentioned, I think the texture of the mouthfeel that you get with the slight carbonation is just it's good. It's smooth. It's great. So would definitely recommend if you're in the area, giving that a try.
Yeah. Yeah, you mentioned real coffee drinkers, making fun of you. Man, my opinion of anybody anybody that enjoys something, if you really enjoy it, then you can appreciate somebody else enjoying it the way that they want, you know. If you're making fun of them, you're probably just a jerk. So it's my opinion. But anyway, yeah, so this morning, we're going to talk about news, and
Mhm.
it's going to segue into our uh, conversation for the morning. There's an article last week on the Wall Street Journal uh, about does strong growth lead to inflation, and about
Mm,
how the Fed is questioning whether the old model still applies. And I'll put a
sure.
caveat out there. I'm not an economist. I'm a businessman. I'm a finance guy. I don't have, I mean, I don't know. I took several, uh,
Macro, micro,
classes.
economics, all the classes we
Yeah,
had to in
economics
college, right?
classes.
Yeah.
Yeah,
So,
yeah, absolutely.
yeah. Yeah.
But it's interesting from my perspective, right? I don't know. I
Mhm.
can't imagine. I mean, it seems very black and white. It seems very algebraic, right? You have demand, you have
Sure.
supply. If you have a period where demand outpaces supply consistently,
Mhm.
prices continue to rise, and then you end up having we call that inflation, right? Whether it's restrictions in the underlying cost of things, the materials. I mean, we've seen that in the construction world, right? In some of our development
Right.
projects, we've seen
Mhm.
prices rise, or maybe it's a lack of tangible supply due to supply chain issues. I mean,
Mhm.
I can't see how the quote old model wouldn't apply. I
Mhm.
mean, it seems very black and white. You know what I mean? What are your thoughts, Joe?
Yeah, I mean, I definitely understand what you mean, and that's kind of always been my interpretation as well, right? And so I think there were a lot of things that, to your point, with COVID and with other things that really haven't gotten completely worked out of the system from a macro perspective yet. And so another big issue, and we were actually going over the numbers at the conference that we went to last week, Nick, were the is just supply in general, housing supply. And there's some markets that are definitely looking oversupplied, Austin being one of them, right? Phoenix, another one. But there's markets like Dallas that's about average, but people keep saying, oh man, there's so much supply coming to the market, all of these things, right? But when you peel back, you actually look at the numbers, we're not really oversupplied as a whole. If you look at our major markets, you look at most of our major markets, will put that caveat on it, and you just look at us across the country. So again, I mean, rent in some areas is falling slightly, but in most areas is holding pretty steady or maybe ticking down just slightly. Or I know there are some markets where it is increasing. So, from an inflation perspective, that has drastically changed how much we spend from our gross income on housing, on our housing needs, whether you're renting or buying. And right now, buying is way out of whack. It's way worse than renting, actually. So I think there's things like that that play into it that maybe we haven't necessarily fully accounted for, or I think there's some argument that they don't look at the right indicators for some of those things. But like Nick said, I'm not an economist. I don't know. I just know I just know looking at it from kind of a business perspective, like he mentioned.
I agree. I agree. And the core CPI index, housing or shelter accounts for, I think, over 40% of that calculation, right? So if you're
Yeah.
looking at it from that perspective, I mean, no wonder we've had such crazy inflation over the
Hmm.
last, 3 years. So maybe that's what they're looking to adjust, because that seems to be an outsized. I mean, in your
Well, and I
budget,
think,
right?
Nick,
Yeah,
do
go
you
ahead.
know, from my understanding, that that indicator is delayed by like 12 months or something. So it's really hard to gauge what's happening right now based on that. Like such a large percentage of how we calculate it is
Right.
looking back so far. So because right now we're probably, again, we're not really increasing rents. Home prices aren't going up like crazy, any of those
Right.
things. But 12 months ago was a little bit different, and even a little further than that, obviously, we were increasing significantly.
Yeah, yeah, and I think that's part of the problems that we've seen that have been created by this whole ordeal, right? You have
Hmm.
inflation, and as we discussed in one of our early episodes, inflation targets are completely subjective.
They are, yeah,
They're or at least they originated from a completely subjective perspective. Um,
right.
and so here you've got almost a self-fulfilling prophecy where, and again, there's a lot to extrapolate here, but I'm sure that some of it goes into play that if you hear that inflation is really bad and prices are going up,
Hmm.
then you kind of get into a cycle where that's your philosophy, right? And so we've got an index that's really delayed, that's very, very much backward looking. And then you've got interest rate changes, right? Changes to the Fed funds rate and
Right.
some of these key benchmarks that are very much forward looking. And so you've got this massive period between the two where
Hmm.
anything can happen.
Yeah.
And, you know, I hear this a lot from a lot of our colleagues, and I'm going to say a lot of, general people, that they're concerned. This, I would include myself in this category. There's a concern that there's overcorrection,
Hmm.
or like we saw, or what I felt like was the case, there was action that needed to be taken sooner,
And it
and
didn't.
on a more
Hmm.
tapered, schedule than what we saw. But
Yeah. Yeah, I'm with you. I think a lot of people feel that way, and it makes it tough. I mean, we're talking about inflation here, and supply is a big factor, right? And so it makes it really tough to keep up with supply. I mean, at the conference we were at, we were mainly talking about North Texas. That's what this conference was focused on, and so very relevant to us, but not relevant to some areas of the country. I mean, we did talk about the country as a whole in some instances, but again, specifically focused on North Texas. We have, I think, I don't remember which is which, Nick, and maybe you do. If it was 28,000 units that were coming online this year, and then 38,000 next year, or maybe it's flipped 38 and 28. And then after that, everything falls off a cliff because new starts have gone down something like 70%, right? So again, we're going to be in another supply issue here in a couple of years where we're saying, suddenly we don't have enough, right? And so is that going to push inflation numbers up? It might, if we don't have enough. And, you know, I mean, the market's going to go as the market goes. If you don't have enough supply, the demand's going to outweigh it, and prices will increase because there's not enough supply. It's like Nick mentioned, just a very basic principle. So I think we're seeing kind of the beginning stages of some of the effects of interest rates rising, particularly on the development side as it relates to supply, and what that's going to look like in maybe, you know, 2 years, 2025 to 2026. We're going to have a lot less deliveries, and that'll mean a lot less supply, particularly here in North Texas. But there's other markets too, throughout the country that's going to happen. There may be a market like Austin
Mhm.
that overbuilt during this time, and so maybe,
Oh
you know,
yeah.
that supply kind of gets worked out over the next couple of years. But yeah, I think, uh, you know, I think there's a lot of markets like Dallas that it's really just producing about where it needs to. And, you know, we're thinking that's an oversupply, but in reality, it's not, particularly with what's coming down the line.
Yeah, yeah. I gotta say, one of the things that I love about what we do is that we're able to see, I'm gonna say in real time, but that's not quite accurate because we do look, we look from a very high perch, right?
Yeah.
Um, but it's interesting to look at the current environment we're in. And I think it's 38, if I remember correctly, I think it's
Hmm.
38,000 this year, 28,000 next year. But
Yeah, that's
you're right,
probably right.
it falls off a cliff because over the last 2 years, as construction costs have gone up, interest rates have gone up. You know, when you put pencil to paper, some of these newer projects don't make as much sense as they would have three
Hmm.
years ago, right? And on the flip side of that, there were a lot of projects that were executed or started, 3 years ago because rates were so incredibly low, right?
Yeah.
Um,
Well, there's that
so it
panel,
is.
and one of the developers was saying, you know, they had somebody that, or maybe it was a lender, I don't remember which one it was. Anyways, they had somebody looking to buy like a Class A unit a couple of years ago, and they did an analysis like, yeah, this isn't worth it. Why don't we just build? It's going to be a lot cheaper for us to build, right? So they did that, but now that ratio is kind of off, and it's a lot tougher.
It is. Well, and now we're seeing that you know people aren't, big firms aren't buying Class A apartments, right? Now we're seeing rise in build to rent, like we're doing in a number of
Hmm.
places, because generically speaking, and Joe, correct me if I'm missing something here. You're very much the expert. Uh, you know, Historically, no, that's not a joke. Historically, you know, you would have these large pension funds
Hmm.
uh, that would go out, or large retirement funds, somebody that's looking for very consistent, steady, long-term income. They would go
Hmm.
out and they would buy these Class A apartments that were newly built because they're low, they don't have to spend a lot on maintenance. They
Yeah.
get higher, they get a large premium for rent. Anyway, but now you're in a situation where it doesn't make sense for those people. Um, so the only way that new apartments are being built are
Mhm.
generally on a build to rent basis, right?
Yeah, I think, you know, Blackstone has been exiting some of their properties and things like that, and cap rates are starting to expand across asset classes, and by that we mean, you know, the cap rate for you to buy a C, a Class C, should be much higher than for you to buy an A, for the points that Nick has outlined, right? They're, generally speaking, you're going to get newer builds with less maintenance, with higher rents, and, you know, I mean, for lack of a better term, you know, better clientele, or maybe we'll say professional clientele, probably in closer in into employment centers, things like that. So when we were just a couple of years ago, cap rates got really compressed, right? So by that I mean everything was very close. A, B, C, all was all close to each other on cap rates, and so these big institutions were just thinking, well, hey, we'll just focus on the Class A. There seems to be less risk there. We're okay if we get, in a place like Austin, if we get 3.5 or 3. I saw some trading for that back then, from a
Wow.
cap rate perspective, right? Because
Wow.
they're expecting it to grow long term, and now they're kind of reassessing that. And so I think, it's kind of interesting to see what the big institutions are doing. And those are the ones that seem to be, getting out of certain portfolios and things like that. While if you've held on to a property for a while, unless you really need to, for a different reason, you're probably not selling right now. And so, there's just not a ton of properties trading hands. I do think, Nick, and you can chime in on this. I think that they were saying there's some of the smaller properties are trading. They're doing some smaller things, like 50 units or something like that, and that
Right.
seems to be working more for the brokers, at least in this environment.
Yeah, yeah, and I imagine that's, probably because if you're gonna put if you're gonna fork out, let's say $5 million, right, in equity,
Hmm.
uh, and something I want to clarify, when we talk about compression and expansion of cap rates, they're compressing towards zero, right, and expanding up, obviously in the opposite direction. So they're compressing all together here in
Hmm.
times where there's a
Right.
lot of demand, right? And then when demand slacks and we see supply increase, then they kind of, they go back up. So anyway, if you're watching, you can get an idea of at least how I visualize it in my mind. But um, yeah, if when we see things, periods like this where we've got, expansion of cap rates, that
Hmm.
means valuations are going to be generally lower than where they would be otherwise. And on the same, side of that coin, you've got banks that are requiring, or lenders that are requiring more equity, more skin in the game
Hmm.
in periods of turmoil. So yeah, it makes sense that they've got smaller deals that are passing. If you're going to put 5 million in equity into a property where, you know, 2 years ago, maybe you were going to put that 5 million into, let's say, a $20 million property, right?
Hmm.
And have 75% loan to value. Uh, Today, when you're looking at, I'm going to say 50 is conservative. I think generally 60 to 65 or
Yeah.
55 to 65 is where banks are. But let's say 50 just for the purposes of our discussion. Now that $5 million is going to get you a much lower deal, right? That's going to get
Hmm.
you a $10
Right.
million deal rather than the 20. So
Right.
it makes sense that we're seeing more smaller deals come on the table than some of these monsters. But it's interesting to see how it all works. And so from our
Hmm.
perspective, you know, one of the things, Joe, you and I talked about last week, when you look at places like Austin,
Yeah.
Austin's got a very similar number of units coming online as they do in Dallas, with,
Right.
as you like to mention, vastly different populations.
Right.
It's what, 2.5 million in Austin and 8 million in
Yeah.
Dallas. Are those numbers right?
Yeah.
Yeah.
I mean, roughly. Yeah. Yeah.
Yeah,
Hmm.
yeah. And you've got the same number of units coming on board. We're gonna see a much higher supply in Austin over the next year or so. And my expectation is that if there is oversupply in Austin, that might be a place where we start to see some distress in 2 or 3 years.
Sure.
I'm gonna say 18 to
Yeah.
24 months.
Yep. Yeah. I agree. I agree. And that's kind of how we look at it. And that's why we don't have a ton in Austin right now. And we'll probably keep it that way for some time. But we still feel like Dallas can absorb it. Actually, Houston's trending towards undersupply right now because there's not a ton
Yeah,
of stuff being built there. I mean, relative to the size of Houston, which is a huge city in and of its own right. It's the fourth largest city in the U.S. From the metro perspective, it's just under Dallas, right? So we have these large centers of populations that have good job growth, and a lot of companies moving in, and they're gonna need supply. That's just the reality of it.
yeah. And you think about it. I mean, let's imagine a scenario where we just have an isolated metro, right? Where you've got a
Hmm.
net neutral inflow and outflow of people, right? you're still going to have some demand for new units coming online as old units are taken offline
Hmm.
you know, destroyed for whatever reason, natural disasters, what have you. So you've already got a natural amount of growth that you're going to see, not growth, but you know, new units coming online, new absorptions, absorbed
Right.
units. And then if you add in all the outflows and the inflows of people, especially in places like Houston, where you've got a lot of people moving there, or
Hmm.
Dallas for that matter, yeah, we're going to see. I think we're going to continue to see some high demand in these places.
Yeah, I'm with you. I'm with you. So hopefully we can work to keep prices lower, right? Because again, that's going to contribute to inflation significantly if we can't. So that's part of the goal. Let's try to keep up here with supply, the supply needs of the markets that we're in, and so it's about working with local municipalities. It's about working with other developers, trying to make sure, that things are on the right track, and make sure we're providing what we need to for the communities. Because we got to keep prices lower in order for people to be able to move in and for it to make sense, right? You don't want to move from say in New York and have to pay the same price to live in Dallas. It's just it wouldn't
Mm,
make sense for a lot of people.
no way, no way. And I have to say, you know, Joe, we've talked a lot over the last, I don't know, several months about how we expect to see more distress, you know, in the markets we operate in over the next coming months.
Hmm.
And, you know, I don't know if we've talked about it on the show or not, but personally, I think we're going to see regulation come out of this of some sort because, you know, we have instances like the Apple's Way portfolio that was, you know, that's been
Hmm.
in the Wall Street Journal, right? Which gives bad representation of what we do,
It
frankly.
does, yeah. Hmm.
And at the end of the day, you know, when we see distress like this, I mean, we're in a difficult period. We're going to see the cream of the crop, you know, rise to the top.
Yeah.
And in operators, and those that fail, those that don't do well, that are, you know, poorly managing their properties, yeah, you know, investors in those properties at some of these firms might lose their investment. But at the end of the day, the people that suffer are the tenants, right?
Hmm.
And in a lot of these places, you know, a lot of it's workforce housing, and that I'm going to say that segment of the population generally have a more difficult time already. So my
Yeah.
expectation is that we'll probably see some regulation come out of this. I'm not sure what that looks like. I'm not sure what
Yeah.
that time frame looks like, but it wouldn't surprise me.
I mean, I agree with you. There was a recent one, another one based in Dallas called Nanban, which I think means friend in whatever language. But they were not just doing real estate, they were also doing options trading. And Nick, I mean, you and I can discuss this actually, but they were promising like 100% returns from their options trading. It's things like that, and they raised something like $130 million just from their community, from their local community, which is a crazy amount of money just from that. And then, guys, if someone's saying they're going to offer you 100% return, that they think they can do that consistently, that is most likely not something you want to be involved in, because that's just unrealistic, especially from an options trading perspective.
Yeah,
I don't know of any professional, any hedge fund, anybody out there that's consistently doing that. You might get lucky now and then, but you're not going to be able to reproduce those results.
no, no. And I'll be honest, when I first started learning about real estate and
Mm,
development and you know, value add deals, I was skeptical because for, you know, most of my life, right? The
mhm.
most of my life where I've learned about economics and markets, capital markets, and equity markets. Some of the returns that we see on these things are amazing. They're phenomenal, right?
Yeah,
They're
yeah,
difficult to believe because historically, in equity markets, if you see somebody say average of 40% annualized return, that raises my spidey senses. Um, and Joe, you know this.
No,
So
I'm with you. Yeah.
Joe and I go through the numbers, and
Hmm.
to a fault sometimes,
Hmm.
I'm I'm double checking and looking to make sure that we've got accurate numbers on some of this stuff.
Yeah.
Uh, uh, Almost overboard because I want to make sure that I can be confident in what we're seeing, and only in seeing do I believe, right? But
Yeah.
even with all of that being said, 100% return annualized, just
Yeah.
run away. Don't even, I just
Yeah.
walk away. Yeah,
No, I'm with you. But I mean, you bring up a good point on that side of it. And I think only being in the stock market for as long as we were working in equities and bonds were treasuries, all of that until very recently were performing very poorly, right? So we saw these returns and then you look at the real estate market, and if you're building, you're getting better returns than that, generally speaking. But you have to look at it more of it's like a product, right? You know what the costs are associated
right.
to build it. And as long as you're able to project those costs well and do a good job of that in mitigating costs and keeping controlling that aspect of it, you generally know what it can sell for. I mean, you try to be conservative on both sides of it and you come out with a good return on it and okay, well, I can kind of control this to a degree, right? Now there's going to be factors that are going to play into it. Like we didn't think rates would rise as quickly as they did, but really, if we're talking about a single family home, property values haven't dropped, but commercial real estate, yeah, that's different. They have dropped, right? But you're still seeing a good amount of let's call it, Nick, you can help me out here, but the margins between what it actually costs and then what your the end value is still significant. So as long as you can project your costs out reasonably and control that through the process, then you still have a really good idea of what that return can be, and it's still a good return even with rates being higher.
And yeah, Joe, you're absolutely right. You're absolutely right. And I think that's a great way to look at it is that we're producing a product, right? Because essentially at the end of the day, that's
Hmm.
that's what it is, you know. Um, And for viewers and listeners, Joe and I run through and like I mentioned, we build out the pro formas, we run the numbers on a lot of these deals, and we're both, I would say, pretty darn conservative, fiscally speaking, especially Joe. Um, and we try to get accurate numbers, but even if we've got what we feel is an accurate number, often we'll even pad it a little bit
Hmm.
to make it a little more conservative because we would rather uh, under under expect, set
Yeah.
expectations below what is realistic, and then if we outperform, then all the better. And honestly, even when we pad these expectations and we make, by pad, I mean maybe we expect cost to be a little higher and maybe we expect revenue
Hmm.
to be a little lower. And even in those instances, we've still got great returns.
Yeah.
Um, because we
Yeah.
just we want to make sure that we plan for a bad scenario. Yeah, go
Yeah,
for
I'm
it.
with you. I mean, I do think right now it's a little bit different time, obviously, than what we had a couple of years ago. And I think you have to be patient as an investor in order to realize those returns. Because, like we talked about, the supply picture is going to change drastically in the next 2 years. So, if it's a situation where you can invest some money and wait 2, 3, maybe even 5 years for your money to come back, I think it's a really good time to invest. Now, if you need the money in the next year, it's probably not, right? I wouldn't recommend it if you needed it the next year because there may be more pain ahead for the next year. But I do think in a couple of years, I mean, we're already seeing, like we talked about, some of these indicators saying, hey, we're not going to have enough. We don't have enough starts right now. So that means we won't have enough deliveries or whatever metric you're looking at. So as an investor, if you can say, give me a, conservatively speaking, like Nick mentioned, 3 to 5 year window, I think you're in a good spot to potentially invest in real estate.
And here's the thing. right now, Joe, I think you make some great points, and I want to paint them a little further here.
Hmm.
So part of what we do, I'm not going to say that I mean, we do what we do for ourselves, for our investors, for our families, for our
Right.
friends. But we also, there is a minor part there that's altruistic because we want to help
Hmm.
improve the environments and the communities that we
Yeah.
operate in. And here's the thing, right now, like we've been talking about, with the expectation that in 2 years, 3 years, I'm going to say 18 to 36 months, maybe that's a more realistic time frame, that there's going to be another shortage because of a lack of starts this year. What that means is the properties that we're building, the the development projects that we've got going on, while we've
Hmm.
projected out based on current environments what we think returns might be, if we're right, if there are shortages 24 months down the road, that means that we're probably going to see rents go up again in those areas
Hmm.
if demand stays stable. And the thing
Yeah.
about demand, you look at cities like San Francisco, LA, Denver, Austin. It's not like the New York, when places become popular, it's not like they become unpopular overnight, right?
Hmm. Yeah.
Society doesn't move that quickly. So even if you've got a scenario where I think Denver is a great example, right? Denver
Hmm.
was growing, population exploded there over what, a 10-year period
Yeah.
before it
Yeah.
started to taper down. And now it's still going up, but the I'm going to say the rate of acceleration has decreased, right? So
Hmm.
maybe it's not going up as much. I mean, look at San Francisco and how long it's been popular. These when we look at the curve and it's going up and starts to taper down, that's a matter of 5, 10, 15, 20 years. So it's not like these places are suddenly going to start
Yeah.
losing people. New
That's
York
that's a
has
good
been
point. Yeah.
New York's been popular for so long, and now I think they have, a net outflow of
Hmm.
people. So
Yeah.
look,
Well, they
look
also
in two
have a
years.
supply problem. I think they're
Yeah,
they're delivering 11,000 units this year in a 20 million, population city. So
that's
that
insane.
doesn't cut it. It doesn't, to your point, like it doesn't matter if you have a ton of in migration or not. I mean, that just doesn't cut it.
Yeah, that's insane. That's insane. So all that being said, looking 2 years down the road and saying, "Hey, we're going to have a supply problem," is not unrealistic in the slightest with where we're sitting right now.
Yeah.
So
Yeah. No, I think that's well said, Nick. So I don't know if you had anything else, but I do have something I think would be fun to close us on. So I don't know if you
yeah,
have anything else you want to cover.
no, so we've kind of gone well around the house, but when we look at inflation,
Yeah.
the old model, if you're going to be looking at including 40% or 40 plus percent in the CPI calculation, core CPI
Hmm.
index, we're probably going to see some of that continue to, in the next couple of years, we might see inflation come back. So it could be a bumpy 5 years for us or longer.
Yeah. No, I don't disagree. So you can tie this in more if you want, but here's what I want to close this on because it's Halloween, right? So we're going to talk about real quick what scares us. It can be inflation. We talked about that is a little bit scary. What out there in the market, and it can be the stock market, whatever financial market you want to discuss. What scares you the most for just in celebration of Halloween, I suppose.
I like that. I like that. Uh, I mean, I'm going to tie it in a little bit here. What scares me,
Hmm.
as I think I've mentioned in previous episodes, my wife and I are in a period of transition. We're looking to settle down and buy a home here in the next year that we're going to be hopefully that we can settle down in for 10, 15, 20 years. We'll
Hmm.
see. But what scares me right now as a person looking to buy a house in the next 12 months is everything that we've talked about, interest rates, home
Yeah.
prices rising, et cetera. Hopefully I can thread that needle, but we'll see. But certainly for my colleagues and my peers or our colleagues and peers out there in our generation and certainly younger trying to buy a house. That's scary. I worry about the wealth building opportunities long term.
Yeah. Yeah, that's a really good one. And I mean, a lot of this ties in together. I think for me, what scares me is the Fed's scary right now, right? That's what I think, because a lot of these things tie into what they end up doing and if they react quick enough or, if their reaction is delayed. And so I think if they either decide to raise rates again or if they hold rates high for too long, I think we look at a really scary scenario from a supply perspective, and that ties into what Nick's talking about with, hey, our younger generation is going to be able to afford housing and things like that. That's what scares me, and so I hope we see some type of change coming soon, or we can at least get some communication from the Fed that, hey, we're finally feeling good about inflation, and we'll think about bringing rates back down to a little bit more reasonable level. I don't think, I mean, historically speaking, Nick, I think they're just a little bit above average, but yeah, we also have not had the issues that we've had on the supply side at every point in the history of the U.S. So I think we need to work on that.
Yeah, I agree with you, Joe. And certainly this is the stuff that keeps me up at night. But to be fair, I would not want to be in a Fed chair seat because it's a lose-lose scenario any way you
It's
cut it.
tough.
But
Yeah.
I'm with you. I feel like there's been, I don't know, too much hesitancy. You know what I mean?
Hmm.
Not enough conviction. I think more conviction would have been better.
Agreed. Yeah. Well, at least we can stay convicted in what we're doing, right? And we know that we believe real estate long term is a great place to invest. And so you can join us if you'd like. Visit our website at www.sitgcapital.com. Send Nick or I a message. Of course, if you can subscribe or recommend us to somebody else, please do. And we'd love to help you and your families take a look and see if real estate in this perspective, multifamily fits into your portfolio from an investment perspective. So let us know how we can help and what questions you and your family might have.
Absolutely. I appreciate the plug. Here's the thing about the environment we're in right now. We've got colleagues and peers out there, other firms that we work with,
Hmm.
that are either hesitant because there's turmoil in the market or can't find deals out there in the market right now. Looking
Right.
on market, can't find stuff. We're in neither of those scenarios. We recognize the signs that are going on. We're looking at the data. This is go time. This is the time where we
Hmm.
can make a
Yeah.
big impact and we can set ourselves up for the future. Uh, it, it- you know, in every environment, you have to be ready to pivot, and we're pivoting. We are there. We've got uh, all sorts of deals in the pipeline. We've got more deals than we can handle right now,
Hmm.
and and I think we're going to be in excellent shape. We'd love to have you on board. We'd love to have a conversation about it and show you how we're improving lives, how we're changing communities, and how we're helping people build wealth. So check us out, sitgcapital.com. But otherwise, Joe, this is fun.
Yeah.
Appreciate your
As
time this
always.
morning.
Yeah. Thank you,
To-
Nick.
I'll give one more plug, Topo Chico Cold Brew, Old City Rooster.
Yeah.
It's
Check
good
it out.
stuff. It's good stuff. But we'll catch you next week. Happy Halloween and have a good day.